I've analysed thousands of Australian portfolios through Navexa, and one pattern never changes. Investors who can answer 5 key questions consistently outperform those who can't. Most people never even think to ask them. They just buy, hope, and guess. In this video, I'll show you those 5 questions and why skipping them can quietly cost you years of progress. These aren't random tips or stock picks, they're the foundation of every smart investor's decision making. Charlie Munger once said, "Opportunity comes to the prepared mind, so let's prepare yours." And of course, this isn't financial advice. It's even more valuable than that, because these 5 questions are what the world's best investors focus on. And if you can't answer them confidently, you might not be ready to invest at all. Let's dig in. Why are you investing? Most people start with a trade, not a plan. They open up a broker app, see something trending, and before they know it, they've bought a company they barely understand. But great investors don't start with a ticker, they start with a reason. Are you investing for long-term growth, for dividends and income, for freedom or early retirement? Or are you just reacting to hype, headlines, or FOMO? The truth is your why drives every other decision. If your goal is income, you'll look for stable dividend-paying stocks. If your goal is growth, you'll accept more risk for higher reward. And if your goal is just to feel like you're doing something, you'll probably end up chasing noise. Great investors are patient, deliberate, and goal-driven. They know why they're doing it before they even pick a stock. If you don't have a reason for investing, the market will decide your reason for you. And the market's reason is never in your favor. Know what you're investing in. Once you know why you're investing, the next step is understanding what you're actually buying. Shares aren't all the same. Some represent big, established companies. Others are small, fast-moving businesses that can double or halve in a month. Then there are ETFs, funds that hold baskets of companies for you. They make it easy to diversify without picking each stock yourself. So ask yourself, are you buying individual companies or letting an ETF do the heavy lifting? Are you focused on income, those steady dividends, or chasing capital growth? Do you want the stability of large caps, or are you comfortable with the roller coaster of small caps? There's no right or wrong here, it just depends on your goals, the why you set earlier. The danger is buying something you don't really understand. You see a chart going up, you click buy, and suddenly you own part of a company you couldn't even describe. That's not investing, that is gambling. If you can't explain what a company does in one sentence, probably not a good idea to invest in it. Before you buy, learn what the business actually does. How it makes money, what might cause it to lose money. You don't need to know everything, but you do need to know enough to sleep at night. Understanding what you own is the first step to understanding how it behaves. Know where you're investing. So you know why you're investing, you know what you're buying. Now it's time to ask, where? Are you buying Australian shares or international ones? That choice changes everything. Your returns, your risk, and even your tax reporting. Australian companies often pay dividends with franking credits, and that means some of the tax has already been paid for you. Overseas investments, though, don't work that way. They might grow faster, but you won't get those credits and you'll face currency risk. Because when you own foreign stocks, their value goes up and down with the exchange rate as well. So sometimes you'll make money from the stock, but actually lose it in the currency movement. Where your money lives affects how it grows. And this isn't just about returns, it's about your strategy. Do you want the familiarity of local companies you know and use? Or do you want exposure to global markets and different currencies? Neither is right or wrong, but each one comes with different rules and tax treatments. A lot of people don't realize that until tax time, and they open up their statements and see foreign income withholding tax and currency conversion that they never expected. So before you invest, decide where you want your money to live and make sure you understand the trade-offs. Because even the best investments can go wrong if your timing and location don't line up. And speaking of timing, that's the next question you need to ask. Know when you're buying and when you'll sell. Even the best investments can disappoint if your timing's all over the place. The best investors think in time frames, not trends. So when are you buying? And just as important, when are you selling? Are you investing a lump sum or using dollar cost averaging and buying a little at a time? DCA smooths out the bumps. You buy more when prices are low, less when they're high. It's boring, but it works. A lump sum can get you in the market faster, but it also exposes you to bigger swings right away. Whatever your approach, make sure it matches your goals and your nerves, because the only bad strategy is one that you'll abandon halfway through. Now, when will you sell? Most people never think that far ahead. They buy with logic, but they end up selling with emotion. And if you don't know when you'll sell, you'll end up selling at the wrong time. You don't have to predict the top or bottom because nobody can, but you do need an exit plan. Maybe it's a price target. Maybe it's a time horizon. Maybe it's when the business stops doing whatever you bought it for. Whatever your rule is, it gives you decision structure, a line between reacting and responding. Because knowing when to sell reveals everything. It shows whether you even have a strategy, whether you truly understand the investment, and whether you're guided by logic or emotion. When you can clearly say why you'd sell, you actually understand why you bought it. Because once you have your criteria for selling, volatility and emotion stop being a threat. Because when the market gets rough or your feelings start pushing you around, you can just ask yourself one question: does this meet my criteria for selling? If not, do nothing. That simple discipline is how you turn emotional reactions into rational decisions. Because timing the market perfectly is impossible. But having a plan always beats reacting in a panic. And that brings us to the final question, one that most investors never think about until it's too late. How will you track your results? Here's the part most investors skip, but it's the one that separates the pros from the punters. How will you actually know if your investments are working out? Most people rely on whatever their broker app shows them. A few green numbers, a few charts, and that's it. But that's not the full story. If you're investing regularly, buying a little each month, reinvesting dividends, or using a DRP, your broker isn't tracking that properly. They'll show you a rough snapshot, but not your real performance over time. And when tax season comes around, that missing data becomes a real nightmare. It's trying to rebuild years of trades, dividend, reinvestments, and cash flows is one of the most painful things an investor can do outside of losing money. So you don't want to find yourself there. The truth is, record keeping pays the biggest dividend of all. The Peter Drucker quote comes to mind: what gets measured gets managed. When you track your portfolio properly, you see patterns in your behavior. You learn what's working and what isn't. You make decisions based on data, not emotions. And the earlier you start, the easier it gets, because your tracking builds a story, your story as an investor. It's not about looking busy, it's about building clarity. That's exactly why I built Navexa in the first place, to make that part simple, accurate, and automatic. Because you don't want to spend tax season buried in spreadsheets. You want your performance, your dividends, and your franking credits all in one clear picture. So you can focus on being a better investor and not a better bookkeeper. So when you know how to track your results, you're no longer guessing, you're growing. That's what turns short-term noise into long-term progress. So before you buy your first share or your next one, make sure you can answer these 5 questions. Why are you investing? What are you investing in? Where is your money going? When will you buy and sell? And how will you track your results? If you can answer all 5 with confidence, you're already ahead of most investors before you even click buy. Great investing isn't about luck or timing, it's about making clear, consistent decisions. These 5 questions help you do exactly that. They keep you focused when markets move, and they stop you from making the costly mistakes most people make without even realizing it. So before you buy your next share, come back to this checklist. Make sure you're thinking like an investor, not reacting like a spectator. Thanks for watching. Check out our next video.